is it a good business we're having? Yeah, is it a good is it a good business? And also, is it a good investment? Yeah. So is it a good business? Is it a good investment? Yeah. And but the thing is that not necessarily if you have a very good business, it doesn't have to be a very good investment. Do you have an idea why a very good business doesn't necessarily have to be a good investment? If you think about it from the perspective of an investor, think about you buying the stock of a company. Any idea why a very good business doesn't necessarily have to be a good investment? It can be even the best company in the world can be a bad investment when it is too expensive. Yeah, think about a very good company, but when it is too expensive, when the stock is too expensive, it can still be a bad investment. Yeah, does that make sense? It always depends on what the price is you have to pay. And if the price for a business, which is the stock price, if you want to buy stocks of a company, and if you buy stocks, you are the owner of a company. If the stock price is too expensive, then it can still be a bad investment, even if it's a good company. Think about a car. Yeah, if you're about to buy a car and you have a very good car, an extremely good car. I don't know what kind of car. Think about a sports car, Ferrari or something like that, or a Mercedes or so. And it's the best car. But if the price is so high, let's say 500,000 euro, then it's a very bad investment. Yeah. So it always depends on the price, and that's the same with business and with businesses. If you pay a too high price for a business, then it can be a lousy investment, even if it's a good or very good company. So, and what we do, we look at the financial statement, and we want to know whether it is a good company. We want to make an economic decision. Yeah, we want to ask ourselves, is the company profitable? Yeah, is it financially healthy? What about the leverage of a company? Can you tell me what leverage means? Have an idea what leverage means? Leverage. Any idea what that means?
I think maybe borrow money from somebody, and then you put this money to invest something, then though you need to give the money back, but you can get the money after the investment.
Yeah. Okay. Yeah. Exactly. It has to do with borrowing money. Yeah. The more money you borrow, the higher your leverage is, and this means that what about your risk? Is it more risky if you have more leverage, or is it less risky?
I think it's less risky because the interest rate is different. When you borrow money, maybe it's 5%, but you invest in something, maybe it's 8%, then you can get more when you are not have so much money.
Yeah, but generally, if we are talking about risk, the more you borrow, the riskier it is. What do you mean, Ray-chan? Good. Tell me again. Yeah. Yeah, but generally, I mean, you're right. Currently, interest rates are relatively low, but nevertheless, the more you borrow, the higher is your risk. Why? Because you have to pay interest, and also you have to pay the money back. Yeah, and you're not sure whether your projects you do with the borrowed money will be successful. Yeah, there's always risk involved, and the more you borrow, the higher is your risk. Yeah, so this is an essential thing. More debt means leverage. More debt means more risk. Yeah, more debt, more risk. Yeah. When we are analyzing a company, we need a couple of years. We need the statements, the financial statements of a couple of years, in order to see the trends, and in order to predict the future performance of a company. Yeah, and generally, the more years we have, the better it is. Yeah, the better it is. Yeah, if we have, let's say if you have 5 years, then it's even better. Yeah, because what we are doing is actually, I mean, we want to know how the company performs in the future, but the more years of the past we have, the better and the more reliable is it to predict the future. Yeah. So, and what do? We calculate ratios. We calculate ratios in order to interpret. Yeah, in order to interpret whether we have a good company or a bad company. Yeah, that is our task. So to sum it up and to sum it up, what do the different statements say about a company? The balance sheet tells us what a firm owns and owes at a specific point in time. Yeah, the income statement, how much a firm has earned during a period, and the cash flow statement is about the cash in and outflows during a period. When we analyze a company, we can do it horizontally. What does that mean? Horizontally, that means means we look, for example, at net income, yeah, or we look at the cash flow from operating activity, and we look at it over time, how it develops, yeah. And we can also, for example, compare net income and cash flow from operating activities, yeah. And in order to say what is the reason for things things to happen, for example, yeah. And we can what we also can do, we can calculate a discounted cash flow model, for example, yeah. If we have predicted the future cash flows, then we can discount them, and we can say, okay, what is actually the value of a company, yeah. And then we have a vertical analysis. What we can do is we can calculate a number, and we can divide something by a base account. So this is basically about percentages, and the advantage of calculating percentages is we can allow for size, for example, yeah. Think about, we have a small business, and then we can compare ourselves with a big business, yeah. We can compare ourselves with a big business if we have percentages, yeah. So for example, we can measure profitability, and one of the possibilities of calculating profitability is to calculate profit margins, yeah. And what does a profit margin tell us about a company? Any idea? What does the profit margin tell us about a company?
Such as BMW, when it sells one more car, then he will get the money, and I think this money may be the margin.
It's about the profitability, yeah. How much money the company makes, yeah. Whether it is profitable or whether it is unprofitable, yeah. And then we can also calculate the profit in relation to an investment, and this is accounting returns, yeah. So for example, we can calculate the profit in relation to the capital invested, Yeah. So this gives us an idea of the return we are making, the return the company is making. When we measure leverage, what can we calculate? Leverage, as I said, is about the financial position of a company. So it's not about the profitability. Yeah. So leverage is not about the profitability, but rather leverage is about the risk of a company, how much liability it has, and how much equity. Yeah. And what we can do is, for example, we can calculate debt or liabilities in relation to equity. Debt or liabilities. The difference between debt and liabilities is liabilities is any thought of what money we have to pay back. Yeah, any sort of money we have to pay back. And debt is actually debt where we have to pay interest on it from a bank or something like that. Yeah. What we also can do, we can calculate debt relative to earnings or cash flows. Yeah. So that tells us how much debt we have, in relation to what the business earns. Yeah. So this is what the business earns, or in relation to the cash flow that is coming in. Yeah. So these are, for example, profitability ratios we can calculate. There is the gross profit margin, which is gross profit divided by sales. Yeah. Net sales, by the way, means that the value added taxes is not included. We have the operating profit margin, which is the operating profit divided by net sales. And then we have the net profit margin. And the net profit is the net profit margin is the net profit, or the net income divided by sales. Yeah, net income and net profit is the same. We have returns. Yeah, we have return on asset, which is the net profit plus the interest expense divided by total assets. Yeah. And then we have what is called the return on equity. And there we have our net profit, and we divide that by our equity. Yeah. So this is a ratio that tells us how effective a firm uses the shareholders' funds. Yeah. Because this is equity. This is shareholders' equity. Yeah. And we can also calculate leverage ratios, which is, now let me go back one. Let me go back. If you have here, for example, a profit margin, is it better to have a high profit margin or a low profit margin? What do you think? Exactly, yeah. A high profit margin is better than a low profit margin, right, John? And if we are talking about the net profit margin, for example, what do you think is good? The net profit divided by net sales. What do you think is a good percentage? Do you have any idea? Is for example, is 1%, is it good? Does that mean that the company is profitable, or is it rather unprofitable? It's not good, yeah? Very good. So you're right. Bad, that means it's bad. Good is, let's say, 15%. That's a good net profit margin. Yeah, 15%. Yeah, some companies have even higher profit margin, but 15% is good. Yeah, that means out of every euro of sales, the company generates 15 cents of net profit. Yeah, this is 15%. That's kind of good. Yeah, if it's only generating 1%, so one cent out of every euro sales, that's bad. Yeah. Does that make sense, or are there any questions?
Here. Huh? Huh? Where?
Yeah.
No.
I is good. I is good. The higher it is, the better it is. Yeah. And now high is, for example, 15%. Yeah, even 10% is good. Yeah, or 20%. You will never get 100%, because 100%. What does that mean? If you have 100%, that means your profit is as good as your sales. This is sales revenue. So it is not really possible that your profit is as high as your revenue. So 100% is unrealistic. Okay, you will never have 100%, but even 15% is good. Yeah, does that make sense? Yeah. Yeah. So 15%. Yeah. So this here we're talking about the net profit margin. Net profit means that's the bottom of the income statement, the bottom line of the income statement. Yeah. So if we are talking about operating profit margin or gross profit margin, this is a little bit higher up the income statement. Yeah. So for example, 15% is very good for net profit margin. Yeah. It is not that good for gross profit margin, because here we are already higher up the income statement. Yeah. But the net profit margin, this is the net income. Yeah, net profit or net income. And this is the bottom line of the income statement. And there, 15% is really good. Net income. this here, return on equity tells us how much profit the company makes. Yeah, the profit in relation to the shareholders' equity. This is the shareholders' equity. Yeah, and here again, if you have, you have, for example, 1%, this is bad. Yeah, what does that mean? That out of every euro of shareholders' equity, the company generates 1 cent in profit. This is bad. Yeah, no shareholder wants to have that. Yeah, but if it's, let's say, 20%, that's good. Think about it. If you are a shareholder and you get 20% on your money, then you are happy. You're much happier than if you get 1%. Yeah. Does that make sense? Or is there any question here? You can always ask me if you have questions. No, okay. So here at the when we're talking about this return on assets here, the return on assets, this is in the denominator. Here we have assets. So this is how much the company generates with its total assets. Yeah, this is not only about the shareholders' equity, but this is about the total assets. Yeah, and here we have in the numerator, we have the net profit, like with the return on equity, but we also have the interest expense. Why is it the interest rates expense? Because this is about total assets, and total assets are equity and liabilities. And what is the fruits of the liability? What the liabilities generate? What the debt holders get? It's interest expense. Yeah. So this is what the shareholders, the debt holders get. It's net profit plus interest expense. Yeah. And you divide that by total assets. Yeah. So if there are any questions, you can always ask me. Yeah. So this is about leverage. As I said, leverage it shows how much liabilities a company has, and how much equity. And if you think about the accounting equation, how does the accounting equation look like? Raychan asks, is interest expense negative? It's let me go back. It is an expense, but I wouldn't say it's negative. Yeah, here in this example, it's not negative, but it's positive. Yeah, it's positive, and because it shows us what the debt holders, yeah, not the shareholders, but the debt holders, what they get out of the business. So here we have net profit, which is possible, which is positive, and interest expense is also positive. So to your answer, Raychan, interest expense is positive. Okay. So here we're talking about leverage, and as you know, this is the accounting equation. Assets equals equity plus liabilities. Yeah. So this is the accounting equation. This is the accounting equation. And so that means here, total assets equals equity plus liabilities. Yeah. So what we do here, yeah, when we calculate leverage, we divide liabilities by equity and liabilities. So what we essentially do is we look at what is the percentage, what is the proportion of liabilities in relation to equity plus liabilities. Yeah, what is liabilities in relation to equity plus liabilities? So what does it mean if this ratio is high? What does it mean if this ratio is high? It means that the company uses a lot of liabilities. Yeah. So if this ratio is, let's say, it is 90%, then this means that the company uses 90% liabilities and only 10% equity, and only 10% equity. Yeah, so 90% means 90% of total assets is liabilities. And then that means only 10% is equity. Yeah, so that means the company uses a lot of liabilities, which means it's risky. Yeah, it's kind of bad. Yeah, does that make sense?
Yes.
Yes. Okay. So a lot of liabilities means it's bad because it's a lot of risk. Yeah, too much liabilities is not good. Yeah, so and if the company uses 90% liabilities, then it's only 10% equity, and it's better if the company has a lot of equity, or at least more equity. Yeah, so 90% equity and 10% liabilities is much more safe than 10% equity, 90% liabilities. Okay. We also have share related ratios. Yeah, we have share related ratios. For example, earnings per share. Yeah, what does earnings per share tell us? It is net income divided by the average number of outstanding shares. What does that tell us? It tells us how much the company earns in relation to one single share. So if you have one single share, if you own one single share of a company, that is what your part of the earnings is. Yeah. So this is it divides the total net income by the number of outstanding shares. Yeah. So, and let's say we have a company. Let's say we have, I don't know, let's say it's Amazon. Yeah, Amazon, and the company earns 10 billion. Yeah, and the number of outstanding shares is 10 billion. Or let's say it's 5 billion. Yeah, then the earnings per share is 2. Yeah, that means that's billion, both is billion. That means that if you own one share, you have two US dollar of earnings per share. Yeah. So this is if you own one single share, you earn $2 US dollars. Yeah. Does that make sense?
Yes.
Yes. Okay. Then we're going to the price earnings ratio. Yeah, and the price earnings ratio is the price per share divided by the earnings per share. The price per share divided by the earnings per share. Yeah. So if the price of, let's say, the price of a share is 100 euro and the earnings per share is, let's say, it's 10 euro. 10 euro. What is our price earnings ratio then?
$10.
Exactly, it's 10. So we have a price earnings ratio of 10. And what do you think, is 10 good or is 10 bad? It's the price of a share of a company.
I think it's bad.
It's
Bad.
Yeah. Okay. Okay. First of all, it tells us about whether a share is cheap or whether it is expensive. Whether it's cheap or whether it is expensive. So here, if we have 100 divided by 10 euro, then we have a price earnings ratio of 10. If we have, let's say, our share price now increases to 200 euro, if we have 200 euro, and let's say our earnings per share is the same, 200 divided by 10. What price earnings ratio do we have here? What's the price earnings ratio here?
20.
20, yeah. So in which case is the share more expensive, and in which case is it cheaper? Is this more expensive? This is cheaper. Exactly. This is this is cheaper. This is cheaper. And this is more expensive. Yeah. So why does a share become more expensive? Do you have an idea? Why do share prices rise, and why do they become more expensive, for example, in relation to the earnings, to what the business earns?
Interest rates.
Okay, it can have to do with interest rates. When interest rates go down, yeah, then share prices rise. That's true. Yeah. But it can also have to do with expectations. If the companies, if the shareholders say, if the investors say, okay, this is a company which is very good, yeah, and will probably earn more in the future, then the share price also rises and the share becomes more expensive. Yeah. So it can be, if a company is very good, then the share price can become more expensive. Yeah. And you should be careful, because if you buy a share and it is too expensive, then it's a bad deal. Yeah. You want to buy a share when it's cheap, because when it's cheap, then it can also rise more. It can increase more. Yeah. Does that make sense?
Yes.
Yes. Okay. And the last ratio I want to talk about with you is the dividend yield. The dividend yield. The dividend yield is the dividend per share divided by the price per share. What is a dividend? Can you remember? What is a dividend? Can you explain what dividend means? Exactly, Raychan. Very good. It's the money to the shareholders. Yeah, it can be the dividend is the payout, what the firm pays to the shareholders, and this can be different than earnings per share, yeah, or net income. Net income or earnings per share is what the business earns. Yeah, but it can be a good company. It can earn a lot of money, but nevertheless pay a very little dividend. Some of the technology companies, for example, they earn a lot of money, yeah, but they pay a low dividend. Yeah. Do you have an idea why companies, even if they earn a lot, why they only pay very little to their share owners?
They need to R&D, research and deliver.
Yeah. Exactly. Yeah, they invest into the business. Yeah, because they think they have good projects. They invest in research. They invest in all these kinds of things. They invest in capital expenditures because they think they have good projects for the future, and it's better for the shareholders. The shareholders are better off if the company invests for the future. Yeah. So for them, they say, okay, it is good if we invest more and if we pay a low dividend out to the shareholders. Yeah, but to this ratio, the dividend yield is the dividend per share divided by the price per share. What do you think from the perspective of a share owner? What is a high dividend yield and what is a low dividend yield? Is, let's say 0.1%. Is this high or is this low? Is this high or low? 0.1%. Is low, yeah? Because think about if you are a share owner, the price is 100, but you only get 0.1 euro of dividend. Yeah, that's very low. That's a very low dividend yield. Yeah, if it is, let's say, 7%, the dividend in relation to the price per share, is this high or low?
High.
That's high. Yeah, 7% in percent as it's the dividend, 7% in relation to the price per share. That is high. Yeah. So this is low, and this is high. Okay, very good job. Let's have a break here. Let's have a break here, and let's continue in let's say 10 minutes. 10 minutes. Good job so far. See you in 10 minutes.